Welcome back to the Neuro Finance Masterclass. We've spent a lot of time establishing Bitcoin as digital gold, a powerful store of value. But you know what? That's really just the opening act. Today, we're venturing beyond Bitcoin to explore the wild, complex, and often misunderstood world of the crypto universe.
So if Bitcoin is the digital equivalent of gold, then what on earth are all those other thousands of cryptocurrencies? The altcoins. For most people looking in from the outside, it just looks like a massive, flashing digital casino full of promises of getting rich quick. And let me tell you, that is a very dangerous way to see it. Today, we're going to tear that perception apart.
An amateur looks at this market, sees thousands of coins with funny names, and all they see is a row of slot machines. Each one is just a random pull of the lever, a bet. Well, that is a fundamentally flawed, and frankly, very expensive misunderstanding. Our goal today is to completely cure you of that illusion, to give you a mental framework to see this world with absolute clarity so you can navigate it with discipline.
Okay, first things first. To understand almost anything about the altcoin space, we have to understand the engine that powers most of it. So let's talk about the second biggest player in the game and the truly revolutionary idea behind it, Ethereum.
Now this, right here, is an absolutely crucial distinction. If Bitcoin is like a decentralized bank vault, a system designed to do one thing and do it exceptionally well, which is store and transfer value, then Ethereum is something else entirely. The best way to think of it is as a decentralized global computer. It's not just for storing money, it's a platform that people can actually build things on top of.
So how do they build on it? Well, the main tool is something called a smart contract. Now, don't let the name intimidate you. It's actually a pretty simple concept. It's just a piece of code that lives on the Ethereum network, and it's programmed to automatically run a transaction if and only if certain conditions are met. No lawyers, no bankers, no one in the middle has to approve it. It just works.
Probably the best analogy for a smart contract is a good old vending machine. It's perfect. You walk up, you see the price for a soda, that's the condition. You put your money in and you push the button for your selection, boom, the conditions have been met. The machine's internal code then runs automatically and it spits out your drink. The entire thing happens without you needing to trust anyone. That is the fundamental power of a smart contract.
Okay, so we have this world computer that lets literally anyone build these cool automated applications. I mean, it sounds incredible, doesn't it? But now we have to pump the brakes. We have to shift from the exciting technology to the cold, hard financial reality. It is time for a neurofitness reality check.
Because this platform, Ethereum, is open for anyone to use, thousands upon thousands of developers have jumped in. They've used smart contracts to build their own unique projects. And to raise money for these projects, they issue their own digital tokens. And these tokens, these are what we call altcoins.
Before we go any further, I want you to just stare at this number and burn it into your mind. 99%. This isn't an exaggeration. This is the statistical reality. It's the historical failure rate of early-stage startups.
So here's the absolute punchline of this entire lesson. Altcoins are not magic internet money. For all intents and purposes, they are equity. They are shares in unregulated, highly experimental, brand new tech startups. So when you buy some random altcoin you saw on the internet, you are not buying a currency. You are acting as a venture capitalist. You're placing a high-risk bet on a fledgling company. And we all know what happens to most startups.
All right, so this begs a pretty big question, right? If the failure rate is astronomically high, why on earth do so many people get sucked in? Why does it feel like a casino? Well, the answer lies in a very powerful psychological trap.
The media, the influencers on social media, all the hype machines, they don't talk about the thousands of projects that went to zero, do they? Of course not. They focus only on the tiny, tiny fraction of winners, that 1% that delivered insane returns. This creates a massively distorted picture of reality. It's a classic cognitive bias called survivorship bias. You only ever hear the success stories, which tricks your brain into thinking winning is common.
And this survivorship bias feeds right into the amateur's worst impulses. They get hit with a massive dose of FOMO, the fear of missing out, and greed takes over. Suddenly, all discipline goes right out the window. They stop their systematic investing, like dollar-cost averaging. Some even do the unthinkable. They sell stable core assets, like their S&P 500 fund, to go all in on some project they heard about 5 minutes ago.
Let's be unequivocally clear about this. This is not investing. It's not even speculating. This is pure gambling, and it is a fatal breach of the financial discipline that we are working so hard to build. It's a decision driven by emotion, not by strategy.
So how do you navigate this incredibly risky space without falling into that trap? Well, you have to fundamentally shift your mindset. It's time for an action plan. And really, it all comes down to a single choice. Are you going to be an architect, or are you going to be a gambler?
Let's break down the difference. The gambler looks at this market and sees a casino. The architect looks at the same market and sees a new, incredibly high-risk tech ecosystem. The gambler acts on FOMO and hype. The architect acts with cold, hard discipline. The gambler makes these crazy all-in bets. The architect manages risk meticulously. You have to consciously choose to be the architect.
So what does being an architect actually look like in practice? Well, here's how you should think about allocation. If, and it's a big if, you choose to invest in this space, you need to have separate mental buckets. Think of Bitcoin and maybe Ethereum as your foundation. They are the core assets. Everything else, every single other altcoin, goes into a completely separate bucket labeled small, high-risk satellite position.
And this brings us to what is, without a doubt, the most important takeaway of this entire session. After all the talk about technology, risk, and psychology, it all boils down to one simple, non-negotiable rule. So what is the one rule that you absolutely must internalize to protect yourself in this arena?
Here it is. I want you to write this down, say it out loud to yourself. I will never invest money into an altcoin that I am not completely willing to lose. That sentence right there is your shield, it's your discipline, it is the bright line that separates the architect from the gambler, and it's the one thing that will ensure your exploration of this crazy new frontier doesn't end in financial disaster. Internalize it. Live by it.